Hi everyone. Okay, so let's jump into part 2 of the DSW Capital analysis. And this company is accessible on Interactive Brokers, which is incredible considering how small it is. A link in the description if you are interested in this one a little bit further and actually wanting to make a trade. Interactive Brokers will get you there. So let's go into the competition and threats first today. I think in the last video I said a lot of the positive things and things that I'm excited about, but I think it's important to highlight some of the negatives as well. So let's jump into that. There's plenty of competition and people can easily start their own accounting and finance businesses. So even though the model is quite unique, there is so many different finance and accounting businesses out there that the fee earners themselves are in a competitive environment. This isn't some very, very weird specific niche that acts in little monopolies or anything like that. There's a lot of businesses out there doing this thing. So no obvious need to go with DSW Capital at first glance, but DSW fee earners can focus on making money and then doing all that other business stuff, like I said before. But the barrier to entry is low and it can be copied as well. This entire model could be copied. Like you and I could go out and try to get this going off the ground. We would struggle with the reputation. We would struggle with the processes in place. I think it does take a grind. I think that's why it's been about 10, maybe 12 years since James and the head office have really tried to leverage this up, and not leverage it from a debt point of view. And what I mean is leverage the time that they've had to put into this business, and to get to the 97 fee earners, I think would be slow. You need reputational and a track record to do this. So even though the barriers to entry to start this up is low, I think there's still some hard work involved. Regarding technological disruptions, I think that might actually help accountants generally with a lot of their mundane like reporting and financial stuff and data entry stuff. I think tech should make things generally better, and the work hopefully is easier so that they can do more value add stuff. And that's really the focus of James and the team at DSW, is that they call themselves like the high-end services. So it's more specialized, it's more analytical. It's going to take a while, I think, for that to be disrupted, rather than general bookkeeping and tax returns and things like that. That could be far more easily automated than the higher end services. Now, regarding things like inflation and macroeconomic factors, that's a big concern. So if there is a serious downturn in the economy, which people are saying is very likely. I don't know. I'm not going to jump into that argument. But if it does happen, we want to kind of stress test this business at some point. Now, firstly, they don't have any debt. And Peter Lynch would say that if you don't have any debt, it's very difficult to go out of business without debt. So that's one thing in their favor so far. They also have quite predictable costs. So they've got about 8 full-time employees at head office, I think. And that's pretty much all the overheads for the head office. Now, I'm just looking at DSW's income statement here at the moment, and as you can see here, after total income, which is the license income that they've got from their fee earners, the only real overheads here, what they call central overheads, which is just those staff, which is this amount of money, 670,000 was spent over the year on the 8 people. It's probably going to be more than that. 8 people seems like it should be higher than that, but anyway, so having just those overheads makes it very simple. The profit margin is really strong. Now, if we look at total income and then we take out those central overheads and some depreciation and some other little costs and tax and stuff like that, it's a pretty simple income statement to understand. There's really not that many transactions going on and that many things happening here. And that conversion rate from the profit after tax from their total income, that's strong. The margins are good here. What do we look at? 40% or so profit margin. So it's got high margins. Now, this tells me that we can handle, considering the overheads are about 670,000, they can handle essentially this total income number getting cut in half, and that should make the profit go to 0, which means we're not even declining the business. We're not even like using the cash reserves that the business has, but this business can quite comfortably handle a 50% decline in revenue earned from the fee earners, which 50% decline, that is extremely dramatic. Like I would imagine in a GFC type event, you'd get a 25-30% reduction maybe. 50% would mean some of the businesses go out of business. So I think that's a pretty good stress test in its own right. So, and they're sitting over $4 million in cash as well. So that gives them even more of a buffer in some sort of dramatic downturn. So I'm feeling pretty good about the risk of this breaking being very low. So I just want to go over some financial checks of the business. And the first thing I want to look at is growth in the business. So we're just going to looking at revenue growth, just straight up top line growth. They say on this graph here that they expect a 40-60 split. That's looking unlikely for 23 this year. I'll explain a little bit later why. They put out a warning to the market and the share price dropped dramatically because the second half isn't looking anywhere near as good as this time last year. Overall, it's going to be about flat, apparently, the revenue for 23 compared to 22. But since over the last 3 years, it has been growing nicely. We're going to have a flat year this year. Maybe we do get a little bit of a decline. But remember, we can handle a 50% decline here. So yeah, it has been growing. So that would be quite a dramatic event for this business. Regarding margins, we've already covered that, and they're really strong because it's a capital-light business. Regarding return on invested capital, the payback time for their new businesses that they're starting up and the ones that they acquire, they're trying to get their money back within 3 years. That's a pretty solid return on invested capital, but some of these don't work out. So I would imagine it's closer to 20% rather than 26% or higher at the moment. Then again, some of them probably do pay back even quicker than that. So we're looking in that 20% range anyway for return on invested capital, which is pretty strong. So regarding debt, like I've said before, they don't have any, so that's good. Now regarding free cash flow, as we can see here on this page of the cash flow statement, the operating cash conversion percentage was 105%, now it's 85%. They're aiming somewhere between this 80 to 100% range of turning profit into operating cash. I think that's great. That's what it should be for a capital light business with very minimal capex. That's good. And we've got the net cash flow here at the moment is negative, but we've got there's a big chunk of dividends got paid out. A lot of this was related to some weird things going on with the IPO that's just happened, and there's a lot of one-off things happening here at the moment. So we just have to be a little bit careful comparing the numbers in the past sort of 6 to 12 months to prior years, just because of those one-off costs. We either have to adjust them out or maybe include them this year, but even it out over a longer period of time, maybe a 3-5 year period, we can even out things, and that's probably the way to go. So shares outstanding is interesting because it has increased a lot recently. Again, this is the IPO factor. James himself is a big owner of the business, doesn't want the share dilution to be a big thing going forward. You can watch the interview I had with James where we talked a little bit about dilution and his strategy and his thinking around that. So I'll leave that for then. But there's not going to be any dramatic moves in that anytime soon, which is good. Regarding the dividend, at the moment, there's a 70% payout ratio from the profit, and that's going out as a dividend. So I don't really like it, but if they can grow the business without needing a lot of money, which they don't need a lot of money to grow, and they don't have any other ways to reinvest it, I actually like the idea that it's coming back to me in my pocket after the withholding tax, which is a bit annoying, but James said that it isn't a strict dividend policy, and I think that's really important. I would prefer probably buybacks at this price. That would be more tax efficient way to return money to me. But anyway, it's not the end of the world here. The machine of DSW Capital can run without much money, which is the exciting part. Okay, now let me cover incentives. So the CEO, James, pays himself about $80,000 and he has more than 15% ownership in the business, equivalent to about £2.4 million. The CFO, Nicole, is the highest paid person in the books. She has about a 1% ownership in the business, which is only about £160,000 compared to her over $300,000 salary. There is some stock-based compensation, and I do want to check this going forward. So I've also figured out that there's about 75% of all the stock, the shares outstanding, is actually already tied up in management between the founders and their family. So that actually doesn't leave much for the rest of us, especially as the CEO has been buying back more shares on the market over the past few months. And just to fact check that, I've got here on the screen here, on the 21st of February 23, there was a notice put out by the company that James Dow, the CEO, purchased 66,666 ordinary shares at a price of 75 pence back on the 21st of February. So that's quite recent. That's a sign that there's even less shares outstanding available to everybody else. This is really only for retail investors like you and me, probably. Funds and anything like that won't be able to touch this. It's just too small. Now, after interviewing the CEO, after going through the last video I made and today, I think I'm ready now to put together a valuation. That's what I'll do in the next video. But just a reminder, with Interactive Brokers, they do have this available. I can't imagine other brokers in the world having this stock available for you to buy shares in. So again, another plug here for Interactive Brokers, link in the description. Tomorrow, I'm going to jump into that valuation and I will pick it up from there.